The Finance and Money programme is proudly brought to you by Landlord Smart.
Welcome to the Money and Finance programme with me, Gemma Forte. We're here at the London Stock Exchange studios in the heart of the city for a unique programme where some of the country's leading experts from the world of finance and property are invited to share unreservedly their views about the industry. So I'm looking to finding out what today brings, so let me introduce my guests straight away. First up, we have Tony Gimple, Paul Mahoney and Piragash Sivanesan. Welcome, gentlemen. Great to see you all today. Now, in today's programme, we are going to be getting the views of our panellists on subjects which include whether and how far private landlords are in the Chancellor's line of fire, the importance, or perhaps not, of investment portfolio diversification, and property as a vehicle for wealth creation. But first, we are going right to the heart of how politics may or may not affect the tens of thousands of private landlords in the country. So we're specifically asking, will Brexit or politics generally, and should I maybe mention Jeremy Corbyn, make life harder for the UK's army of private landlords? So, Tony, I might start with you with this one. What do you think?
There's a shortage of housing, an ageing population. Brexit will play out overall for the good. Either way, people are still going to need homes. Landlords, however, are a visible target for politicians of every colour. One would have thought that a Tory government wouldn't try and tax landlords out of existence, but they have with Section 24. On the far left, Marxism, property is theft, and the government is in the hands of rogue landlords. So come what may, politics, Brexit, taxation, landlords are still going to be in the firing line. That said, if they're running professional property businesses, they will be able to provide a real social function to occupy the vacuum that the lack of public money, both at a local and national level, in providing quality, affordable housing, but at either end of the market. So yes, it's going to be tough. Yes, there'll be more attacks, to fund the gaps in social care. But overall, if landlords do the right things, build the right properties, work with the system, then they'll come through the other end like any other business should.
I suppose that is the problem that they're trying to solve, is the fact that rents are so high now, aren't they? And with so many people not able to get on the property ladder, there is an inherent problem there and an imbalance which I guess they're trying to address. What do you think, Paul?
I think that's the way it was spun. But in reality, I think landlords are just a soft target. Landlords are viewed as fat cats that, steal from the poor, but that's not the truth. Landlords provide housing to a market that vastly needs housing. The government needed money to fill out their budget, and they targeted landlords to get it. I think that seems to be the general sort of consensus view of property industry professionals now that we've had time to digest the changes. I think the two topics actually tie into each other quite well, being Brexit and further targeting, further legislative change, in that with Brexit, the government's going to be very busy on things that aren't landlords. So I think certainly in the short term, it would be very difficult for any more focus to be given to hurting landlords, which is probably a good thing.
And when you say hurting landlords, though, is it not the professional landlords as such they're going after, but the individuals who've in the past had some pension pot, if you like, and they've put it into property because they can and because it's, if you like, an easy way to make money, and they're trying to clamp down on that a bit?
Again, that's a way of looking at it, that they're looking to professionalise landlords, and certainly if landlords are doing things the right way, it can mitigate the effects of all of these changes. There is certainly more reason now to have a proper strategy to deal with current legislation, as opposed to in the past it's been a very sort of DIY type activity. You know, go down, speak to your local estate agent, buy a property and make loads of money. That's not what it's about anymore. You know, you need to make sure that you're structuring things in the right way, that you have a strategy, a clear idea of your goals. As Tony said, a business plan, because that's what it is. You know, investing in property is a business, and you need to go about it in the right way.
Okay, so essentially things have got tougher, much tougher recently, but you think that Brexit, rather than make things even harder, it's actually a distraction.
It is. Brexit is a distraction all the way around. You know, we're a maritime trading nation. So we'll continue to do what we've always done, you know, make money through opportunity and adversity.
Yeah.
But government only seeks to regulate sectors which are making money and doing well, because there's no mileage in spending public funds on failing industries.
Yeah.
And the housing sector, the private landlord sector, works on every single level.
What about you, Piragash? Is politics something you're particularly interested in, or you try to avoid?
I think despite whatever my political view is, I think one of the most interesting things, you mentioned Jeremy Corbyn. People have been talking about rent controls being a disaster. People are talking about him going after big businesses. But actually, like my colleagues have said, ultimately, if you're a business, if you're a property owner in this environment, there are only two main political parties. You've got to prepare for probably a Conservative government or prepare for a Labour government.
Yeah.
And when we talk about rent controls and things like that, New York State has had rent controls since 1942, yet we're still talking about one of the most buoyant real estate markets. The other thing is I back entrepreneurs, I back the landlords in this market. They will find a way. We've already seen with the number of legislation, lenders as well will innovate. They'll find new ways in order to lend money in a legal way. I think with regards to Brexit, my underlying feeling is let's get some certainty into it. That's what's going to help everyone. You know, I think while we're sitting here debating, could this happen? Could this happen? Let's imagine you're a landlord based in student housing. As of today, students are incorporated within the immigration cap. Now, that would be a big worry for me, because foreign students coming in are actually potentially a big earner, and we're seeing loads of cities with great big developments really on the back of student housing. So I always think these sorts of things presents opportunities, and I think absolutely what you said about the accidental landlord, it will become harder and harder for them. But equally, when we talk about innovation, there's crowdfunding now, there's REITs, there's different ways for people to invest in property, still get that exposure. But today, I think, marks an important line. I think if you're going to become a landlord in the future, you do have to professionalise. There is plenty of opportunity for you to take advantage of the opportunities coming. Okay,
so property as a vehicle for wealth then, largely sort of, it doesn't touch it really. What do you think, Paul?
Well, you know, it remains the same. You know, short-term legislative changes, things like Brexit, it doesn't affect property as an asset class longer term. As we've been saying, you just need to make sure you have the right strategy in place. Obviously, there's been a lot of negative media around the recent changes, and from what I've seen, the examples that are used in that are very much spun toward the articles that are written. So property is still, in my view, the best asset class for creating and storing wealth for the broadest range of people, especially those that are looking to be quite passive.
Well, as you say, because what are the options? If you don't invest in property, I guess you're looking at the stock market, and you know that could be a lot riskier for a lot of people. But you know, property tends to hold its value unless something goes horribly wrong, doesn't it?
Well, it does. It's quite opposite. We're in the capital of capitalism, the London Stock Exchange, and equities are highly sentiment based. You know, the price we pay for fuel is precious little based on what it costs to get out the ground, but on what people will think it'd be worth in the future. And that hasn't changed since Roman times. The Romans speculated on the Egyptian grain crop. Bricks and mortar, somewhere for people to live, is readily understood. If done properly, capital growth notwithstanding, which is actually worthless until you come to cash it in, is great income, provides a nice resource for future generations, and when done properly, is highly sustainable.
Yeah. Plus, in terms of sort of Europe as a whole, I think particularly us Brits, we see property as something that we really aspire to. You know, I know in Italy and other countries, the culture just isn't the same. There's not such kudos in sort of owning your own property. It's not necessarily something you expect, and people will rent for years and years and years. So maybe also just culturally, we're very sort of embedded towards wanting to have our own property.
You know, Tony mentioned before, but the stability of property, that regardless of what's happening in the economy, people need somewhere to live.
Yes.
And in the UK, we have a massive undersupply in comparison to a growing demand.
Yeah.
We're building around half of the required yearly supply and have been doing so for over a decade. And whilst ever you've got a dynamic like that in the market, it's impossible to argue against prices continuing to increase over the mid to long term. It's obviously cyclical, but as a property investor, so long as you're buying in the right areas, even if the economy completely goes belly up, people still need to live, you know, in a house. They still need a roof over their heads. So you can have confidence in the right circumstances that your rent is sustainable. And prices don't really matter when you own property. You don't have a ticker on your letterbox. You can't really tell what the price is until it comes time to sell it or remortgage it.
Yeah.
So unless you need to sell at that, you know, very bad point in time, it doesn't really matter. It's a paper loss. So as a long-term investment asset, it works really well.
Yeah, and I think we all know that things have cooled off a little bit in the capital. But actually, maybe on a positive note, what recent legislation has meant is that the wealth is being distributed further, you know, into the rest of the UK.
Well, yeah, you just have to look at things like HS2, Crossrail and so on. You know, compare yields to the North East, 14% pre-tax, not very much capital growth. London, 1.8%, 2%, but lots of capital growth historically. And income is easier to turn into capital sometimes than capital itself, and it does spread the wealth around the country.
Yeah, and you mentioned before, you know, all the speculation around Brexit. Of course, we don't know exactly what's going to happen. Nobody does. It's still, I don't think the government know exactly how it's going to play out yet. Still trying to figure it out. So, but perhaps people now, we've gone through, at first when Brexit came out, everything sort of stopped, didn't it? People were waiting to find out, and now perhaps people just simply need to get on with their working lives.
I think more than ever, what's really important when people talk about wealth, it means different things to different people. For some people, wealth means generating a certain cash flow going forward. For others, it is literally about having a bricks and mortar asset worth X million. And I think if people start with that, I think the next thing really is that, you know, something I'm sure my colleagues will agree is that property actually is really vast. There's loads of little niches within that. There's buying your own home, a home that you live in that will generate a little bit of wealth for you. But there's also investing. There's simple investing, the buy-to-let that everybody, well, it seems like everybody owns or everybody's next door neighbour owns. But there's development finance. There's you know, houses of multiple occupation. There's commercial property versus residential property, which is another different way of kind of investing. And like I reiterated, there's also funds. There's different ways of getting exposure. You know, for someone, they can start off very small in a way that makes sense, that shields, that can use kind of tax structures, etc., that kind of really shields their wealth. So I think underlying property, I mean, I really wanted to say very early on, let's compare that to Bitcoin, you know, what's happening of recent time. I mean, it's gone up, it's gone down, but in the very short term, that provides very little stability of wealth.
Yes.
But it's an asset class. And property, I think we're all passionate about it because I think there are so many different ways to kind of invest in it.
Okay.
Yeah. And I think far too many people do look at the property market from a macro perspective, and there's not really such a thing. There's no UK property index, as far as I know. There's probably one created for the stock exchange, but there's no real index. And certainly with all these changes, there's by all means a two-speed market at the moment. I think a big shift away from high value, low yield properties toward lower value, higher yielding properties.
Yes, yes. Well, thank you very much. Most interesting, but I'm afraid that's all we've got time for in this part of the programme. But don't go away, because as soon as we get back, we'll be tackling the issues of risk, leverage and investment 101. So don't go away.
The Finance and Money programme is proudly brought to you by Landlord Smart.
Welcome back to part 2 of this Money and Finance special with me, Gemma Forte, and my guests today, who are Tony Gimple, Paul Mahoney and Piragash Sivanesan. Okay, so tax regulation and licensing are some of the most unpopular words in the financial dictionary. So let's find out why. So, Tony, I might start with you. Do you think that landlords are going to remain in the tax firing line over the next few years?
Yes.
Okay.
Increasingly.
And we'll end it there.
If only it was that easy. Increasingly so.
Yeah.
They're an easy target. People think they make excess profits for doing nothing. Well, being a landlord is hard work. Tenants and toilets is not an easy thing.
Yeah.
But it's visible. And the Conservative government has deliberately targeted landlords and set a huge trap. The introduction of Section 24 and so forth is caused a lot of landlords to incorporate their businesses.
Right.
In a few years, the Chancellor of the day, left or right, will mimic what George Osborne did with capital gains tax and almost certainly introduce a surcharge on corporation tax for property companies, because they have to get the money back somehow.
Yeah.
And that could be very painful. The other problem is that for some obscure reason, being a landlord is treated as being an investment business as opposed to being a trading business. And yet, working as a landlord, actively managing, be it social or high-end, is just as physical and hard work as managing a corner shop or running a professional practice.
Yeah.
Taxation will continue to be a problem.
Yeah, I mean, as you say, if you're a responsible, good landlord, the kind of landlord that we would all want, then it is hard work. And you are kind of at the call, if you like, of your tenants. However, I suppose, as you also say, it's always going to be a popular one, isn't it? Most people can say, well, if you've got enough money to be able to invest in having sort of extra property, which is the way many people see it, who can argue with that? It's a tricky one.
Well, let's take the other end. We have clients in Bristol, some of whom are recovered addicts, who run social housing as landlords, literally looking after people coming out of addiction.
Right.
Are they investment landlords or are they working landlords?
So would they have the same legislation applied to them? Okay.
Exactly the same as somebody who's just made a killing on the stock market, decides to invest the profits and do nothing else.
Yeah, that does seem very unfair.
It is totally unfair. You know, running a property portfolio, actively running a property portfolio, is every much a trading business as any other kind of business.
Yeah, and I suppose that if you're looking at entrepreneurial spirit as well, it's almost like, you know, punishing people for doing well.
Yes.
I think it's important to keep in mind, though, that because a lot of people focus, especially at the moment, on tax, because there's been all these tax changes. You're only taxed when you're making money. True. There's an old saying, don't let the tax tail wag the investment dog. You know, focus on making money. Yes. Structure it the right way, and then aim to mitigate the tax.
Yeah. You're never going to pay, as you say, more tax than you've made money.
Well, that's right. So being scared out of doing something because of the tax you might have to pay isn't very logical in my view.
Yeah, agreed.
So obviously focus on what your goals, put in place a strategy that's most suitable for you, make the investments to fit that strategy, and put some tax strategies in place to sort of supplement that. But the main focus shouldn't be the tax that needs to be paid.
Yes. And you are sort of, it's more individuals and the people you mentioned will suffer. And there is an argument surely for just putting corporation tax up by 1%. Solve a lot of problems, wouldn't it?
It's not so much how much tax we pay, it's what we get for it.
Yeah.
If government were to hypothecate taxes, old Liberal Democrat policy, a penny on the pound in tax for education, we'd have a very different society.
Yeah.
Sadly though, all governments seem incapable of wanting to have a jam jar for a particular tax pot.
Yeah.
And they'd rather spend it behind the scenes. It funds the occasional war and so on.
And of course also only 2 parties now as well, which is, it basically is a 2-horse race, isn't it? Which makes life Quite interesting as well. It's never really been like that before. Right, Piragash, let's come to you and talk a little bit about regulation. What are the key differences between regulated and unregulated finance, and where can unregulated finance be of benefit to those seeking finance for property?
So, for those guys at home, this is the bit where they probably start yawning
They go, what?
a lot. But really, for the consumer, the difference between unregulated and regulated is all about protection. Because an individual that perhaps doesn't do any finance or is not particularly educated in all the elements of finance, when they're going and buying their first home, we're talking, especially in the UK now, hundreds of thousands of pounds worth of debt that they might be taking on. And it's really important that they're protected, that the advice that they get when they take on that, both from the lender and or a broker that supports them, is right and fit.
Yeah.
It's also something that should be easy to explain. So there is a whole industry around this. Your high street banks typically are regulated and, well, are regulated, not typically are regulated, and also the broker that supports that. Now, the unregulated space, initially you could be thinking, okay, that sounds like the Wild West, and it isn't, but the main difference is that there is the assumption that someone who invests for business, someone who invests actually, does have a little bit of knowledge. So what that does is it provides a little bit of space and a gap for the lender to assume a certain level of understanding, and therefore can concentrate in perhaps in being a little bit more innovative in the actual financial product.
Okay.
So when you say, how can an unregulated product help me? Well, if I was going to invest in a business and that business depended on a set of projections that I decided would be likely based on a business plan, now to some degree the lender can look at it, it has to be comfortable, but it doesn't need to kind of walk you through your own business plan, whereas if it was regulated it would.
Yeah.
An interesting area very recently where the two are sort of overlapped is consumer buy-to-let.
Okay.
So this is where you have your accidental landlord who suddenly finds himself renting out a property, maybe gets quite leveraged. What I mean by leverage is that they get maybe 85% loan to value on their debt. Are they thinking about the way interest rates will affect their ability to make their interest payments? None of that is linked to someone being employed by their employer and being able to pay off their mortgage. It's slightly different.
Yeah.
And so that's where the government, the FCA, came and said, actually, we feel we need to protect these accidental landlords and provide a little bit more regulation. Now, the types of financial products you can get in the unregulated space is simply much wider. But there is an assumption that the people who take on those products understand them.
Okay.
So limited companies say, if you're just incorporating your buy-to-let portfolio and now become a limited company, potentially you're borrowing money in the unregulated space and losing the kind of consumer protection you would as the accidental individual landlord, even with a similar sized portfolio.
Absolutely. So in that case, it's a really good example where you could say nothing's really changed. Should they continue to be protected? Should they really have access to the type of products that an unregulated space does, etc.? I mean, regulation is a very difficult thing, and there's always got to be a boundary somewhere.
Yeah.
Certainly what Tony describes is where the line probably is drawn.
Okay.
In saying that though, that level of regulation does apply in the same way to somebody who's investing as an individual,
Yes.
intentionally,
Yes.
as opposed to accidentally.
Yes.
Something I think is quite interesting at the moment with all these changes with regards to how lenders need to look at serviceability of mortgages and things, which is the regulated space, but does apply to the unregulated space as well, through depending on which lender you are. Is that it does seem like there may be a new sort of wave, and perhaps you better comment on this, but a new wave of buy-to-let lenders who will be unregulated and a lot more flexible to counteract a lot of the changes that happen in the market, because there is definitely an opportunity there.
Yes.
It's interesting because whatever happens within the industry, everybody is pragmatic and everybody changes with it. So here's a question. Does being licensed as a landlord detract from your bottom line?
If you read some of the comments, you'd think the answer would be yes.
Right.
And where there's rampant disregard for what licensing means, it well could.
Okay.
However, well-regulated, well-run, sustainable properties, licensed, will add value across the board.
Okay.
Because there is a definite market out there for people who want to rent high quality, safe, secure, good place to raise the kids and live housing. And only licensing can achieve that.
Okay.
It all comes down to the enforcement. Like any form of regulation and compliance, outcome based, it depends how well it's being enforced. What we have seen is poor landlords are running away from licensing. Good quality landlords are making the investment now. Higher rents, longer term tenants, greater capital values. So once it comes in across the board to an agreed standard, it's done because it should be, not just because it can, then licensing will start to add to the bottom line, but not overnight.
Okay, I think sort of what's becoming more and more clear is that professional advice is the key to investing at the moment, more than ever. It's not something you can navigate so easily as an individual if it's not your professional career, definitely.
And I agree with what Tony said there. It is about the actual implementation of why you need a license, not just for local councils to collect a few £100 from you.
Right.
Because it does, with the licensing the way it is at the moment, and it's very sort of hodgepodge all over the place, it does seem in some cases it's literally just about collecting a few £100 from landlords. Whereas if it's put in place to make sure the landlords are actually doing the right thing and they're offering safe places to live for the tenants, all that sort of thing, that's obviously where it adds value.
Okay, excellent. Well, we're going to have to leave that part there, but we will be coming back after another quick pause. And in that part, we should be looking at how important portfolio balance and diversification is for landlords. So we'll see you after the break.
The Finance and Money programme is proudly brought to you by Landlord Smart.
Welcome back to this Money and Finance special with me, Gemma Forte, and my guests today, who are Tony Gimple, Paul Mahoney and Piragash Sivanesan. Right, gentlemen, on to the final part of the show, and we want to talk a little bit about portfolio balance and diversification. So, will having a balanced and diversified portfolio help landlords weather any potential storm? And if so, what would that look like? Piragash, let's start with you.
I think before getting into the question in particular depth, I think it's worth kind of looking at recent kind of corporate failures. We've had in recent times Monarch, the airline, we've had Maplin, we've had Toys R Us.
Yes.
These are huge organisations which have, for whatever reason, taken their eye off the ball and unfortunately resulted in bankruptcies, etc. Now, you can apply that same thing to your property portfolio. Monarch, when it, for example, couldn't manage the price of oil, again, for landlords, what is that? That's interest rates.
Okay.
How does a landlord really think about the way in which the impact of rates will impact their business going forward? Equally, Monarch had a situation where terrorism, something that you just wouldn't ordinarily think hit.
Well, you wouldn't have done so many years ago necessarily,
exactly, but certainly impact some of their most profitable routes. Now, that's scenario planning. That's thinking, what if an extreme leftist government came in?
So it's like risk strategy.
It's a risk strategy, and it's really starting to. So once you start to interplay all of those, then you can start to see, is my property portfolio balanced? Because once you run it through those scenarios, if, for example, you've got all your property in central London and they're all buy-to-lets, for example, what does that now look like if there's an issue in central London, or if licensing happens in London in a way that you don't expect?
Yeah, right, okay.
What if, so now you can start thinking geographically. Equally, there are different elements to property, like we've discussed throughout the show: commercial, residential, development. How do each of these play out? HMOs. So this is house of multiple occupation. So this is where you have a number of individuals in a house. Your yield is a lot higher, but of course that business has its own risks. Institutional money coming in and creating these incredible units with cinemas and all. How do you compete as a landlord? So absolutely, balance is all about, but how do you know day one if I have balance? Well, I'll test it. I'll scenario test it for all the different things that we've talked about and the stuff we haven't thought about.
Yes.
That's the way
well,
we
you see,
start
because I
to do
really like that analogy, and it's a very interesting way of looking at it. But then, okay, so with Toys R Us you mentioned, perhaps with them it was just a case of the whole world changing around them, the market changing, people playing on video games more, not playing with toys as much, possibly, has been one reason cited in that. So maybe with property there are things you can't possibly predict as well.
I think the key is exactly that, strategy, and reviewing that strategy. It's not the type of thing you can just do now and be confident in making money from for the next 20, 30 years. Remembering that the demand for your property comes from the target market, and what that target market wants changes.
Yes.
It's the same as the Toys R Us story. You know, they became irrelevant because they didn't change with the market.
Change with the market, yeah.
And of course, you know, in any business strategy, you need to do that. So you need to make sure that your portfolio, if we're talking property, is changing in line with where the demand is skewed.
Yeah, so maybe it's just the market is going to start separating the wheat from the chaff, if you like. As you say, maybe 20 years ago, it would be harder not to make money. If you had a nest egg and put it into property, prices were just spiralling so much, it would have been difficult not to go, oh, I'm a property investor and I've done so well. And that's changed now.
But that's also being driven by not just the tax changes, but the changes in the by the PRA, Prudential Regulation Authority.
Yeah, easy for us to say, yeah.
Or not, as the case may be, when it comes to buy-to-let mortgages, because they've now got to look across a whole range, balance, tax, business plans, how you're dealing with voids, how you're going to deal with dilapidations, changes in the market, politics, right across the board. So, you know, if you're selling a finance product, lending to buy-to-let landlords, how are they going to cope across all of these measures? It's no longer just about rate and term. It's about the business as a whole. And if Toys R Us bankers would have looked at them to the same degree as, you know, any good mortgage lender would now look at, you know, portfolio buy-to-let landlord, they may not have lent the money, or will advise them, you want the money, you're going to have to look at the market in a different way and have much more balance and diversification.
Yeah.
And it's a very relevant point with all the changes we've been discussing, because there are a lot of strategies or more specifically portfolios that worked up until now.
Yeah.
And over the next 4 years, as these changes are implemented, will start to work less and less. A lot of landlords will find themselves in a position of actually making a loss, whereas previously they might have been making a slight gain. So that's a good example of how things change and how you need to change your strategy in line with that. And I suppose approach things in more of a strategic way.
Yes.
The best way to do that is to get professional advice.
Well, I was going to say, yeah. And so you think there'll be a lot of people caught on the hop, a lot of private landlords. It's
Absolutely.
just going to suddenly come in and it really affect them without them even knowing?
Well, using the examples mentioned before, central London, your leveraged property where yields are very low, not only will these tax changes affect those properties that might have been slightly cash flow positive previously and now they'll probably end up negative, but also the mortgage changes we've just been discussing. When they come time to remortgage, that may not even be to get money out, it might just be because their terms are running out. They won't be able to borrow as much, anywhere near as much as they could previously.
Yeah.
So there's multiple challenges for that type of property at the moment, and that is causing quite a shift away from that type of property.
I think also the interesting thing about central London we were talking about is sometimes you can have your own strategy about what it is you're trying to do. It may not work and you might think, okay, but I'll just hold on for a bit because the market will change because you think everybody's like you. I was at a seminar in Europe last week and the view was there is someone did a study, there's 370 billion pounds worth of money ready to come invest in the UK in property. And that, you can't understand their mindset. You know, you have to figure it out for yourself, and if something doesn't work, be prepared to change.
Yeah.
And it might be because you're going to suddenly go out to the Midlands and invest, or in the north of England, or completely change your strategy. What you can't necessarily do is stick there and hope that the rest of the market is exactly like you.
Right, okay. Gosh, it is very interesting indeed. Right. What are the investment options then, would you say, in terms of sort of property? What are other investment options?
If you simplify it,
Yes.
we've spoken about property, you have equities and cash-bearing investments.
Yes.
That's really the only three things that you can invest in that are, in my view, actual investments. You can invest in things like gold and foreign exchange and cryptocurrency, but they are solely capital-based. They don't generate an income, and therefore they're not really investments, they're speculations. So the three options really simply is cash-bearing investments, which is all income, equities, which is income and growth, property, which is income and growth. So, you know, you can be very simple about that. In my view, the reason property is better for a broader range of people when it comes to creating and storing wealth is the ability for leverage.
Yeah.
Because from a returns perspective, when you compare property with equities, obviously if you look at cash-bearing investments or interest-bearing investments, the return, you know, is always going to be less than the other two.
Yeah.
Because it only provides you with one form of income. If you compare property with equities, overall, as a cash purchase, the returns are pretty similar across the board on a high level. Property tends to be more stable, so that's one benefit that it offers. But when you add the leverage in, that's what separates property.
Right.
The ability to borrow over the long term on low interest rates, relatively high loan to value ratios, and no ability for lenders to recall the mortgage unless you do something wrong or you get to the end of the term. So you take a deposit, you leverage it 4 times, you know, 75% mortgage,
Yeah.
and receive all of your returns on the overall asset value.
So with regard to leverage, what are the risks of over or under leveraging?
Well, I suppose if we're talking about property,
Yeah.
the only risk of leveraging is that you can't service the mortgage.
Okay.
So you can leverage as much as you like, so long as you can continue to service that mortgage, there's no risk. But the risk is that perhaps you can't.
Okay.
Maybe your property's empty. Of course, the capital value could fall, but remembering, unless you sell, that's never crystallised.
Well, unless that is, you're on unregulated terms, and the deal you've agreed with your lender says you mustn't fall below a given loan to value.
But generally that doesn't apply to residential buy-to-let mortgages, I suppose. Is not,
Yeah.
So in terms of diversity and balance, sort of you as individuals even, would you think it'd be better to have some property here and not put everything into one pie?
Yes.
Yeah.
Unless it's a very short-term pie
Yeah.
where you understand what you're doing,
Yeah.
you're in, you're out, you can predict the profit, you can predict the costs. If you're looking for the longer term, you want a balanced portfolio in a balanced geography,
Yeah.
following the trends.
Because a lot of people always stick with what they know, don't they? So they invest in their area where they grew up and because they understand it.
But even within that, you still need a balance between single ASTs to HMOs or commercial, or a balance of them all. If you can, however, access your capital, recycle it, and have, like any other business would, a portfolio based on geography, demand, and type. So, if one part of the portfolio tanks, the others will easily make up the slack. You're not going to go out of business tomorrow.
Okay.
I think, attached to that, I'm sure there's a lot of people at home going, oh, balanced, boring, balanced, But actually, if you want sky-high returns, the problem is the probability of it actually coming off is low. The way in which you create true wealth, I would say, is over the medium and long term. So what you really need is something stable that is constantly able to compound. Now, how you actually piece that pie up is very much dependent on your own personal circumstances. But it's boring, but that is the way true wealth is created.
Slow and steady wins the race.
I think so.
But it's not static either.
Yeah.
On that same point, it's very important to understand what types of, we spoke about diversification in property, and you can diversify vastly across different types of returns and different values, geographical areas, etc. But it's important to understand what types of returns are most suitable for you and your stage of life, where you're at.
Yes.
Because somebody that's very wealthy and is just looking to store their wealth and generate income has a very different criteria to somebody who's looking to create wealth.
Yes, absolutely. And I guess when all is said and done, it is all about those things, but it's also always a little bit of luck sometimes, because perhaps somebody that invested in Manchester how many years ago, and now things are moving away from London a little bit, and suddenly that investment is even better.
One of our most successful clients with well in excess of 300 properties and rich beyond the dreams of avarice, one day turned left out of the station as opposed to turn right. He saw a property and thought, that can't be as cheap as that, and it was, and he bought it, and 30 years later, completely and utterly independently wealthy.
So that's how he began.
Yeah, purely chance.
Yeah.
Nothing more. And
Although, so yes, absolutely, and yet he was opportunistic enough to go
Correct.
for it, and dynamic enough to take the risk. And,
Correct.
Yeah, but yes, exactly. Well, I think it's been absolutely fascinating, and thank you so much to all of you for joining us here on this Money and Finance special. And sadly, that is all we've got time for today. But please join us next time when industry experts will be sharing their views, tackling other topics within the world of money and finance. So thank you so much to Tony Gimple, Paul Mahoney and Piragash Sivanesan. That's all from me, Gemma Forte. I'll see you next time.
The Finance and Money programme is proudly brought to you by Landlord Smart,